Hey friends, welcome back to the channel. And in this video, let's continue our series of Peter Lynch investment strategy. And in this video, we'll be talking about the stocks that you need to avoid when you are building up your own personal portfolio. The first one is to avoid the hottest stock in the hottest industry. Now, the main idea behind it is that every investor hears about it, and its stock can go up very fast, mainly because of the optimism of the investors around the stock or the industry. And because there's not much value or there's not much hope behind that stock, it can go down just as quickly. The one thing that to keep in mind while investing in the hottest industry is that this kind of industry often attracts a very smart crowd, and entrepreneurs and venture capitalists stay awake nights trying to figure out how to get into the act as quickly as possible. And because of this, if someone has a can't feel idea but don't have any niche or a patent protecting that, they are going to attract a lot of competition. Now, if there is a lot of competition in an industry, it is very hard to find up a stock that could give you a multi-bagger returns. For example, you can have of the AI industry that has been in the news lately, and you will see that if there were only one or two main producer of these AI models that they're providing to the people, you can easily invest in those, and you'll be very sure that their stock is going to go up. But if we see that there is a lot of competition in the market, and because of that competition, people are going to cut their cost just to get as much market share as possible. Now, given all this scenario, it will be very difficult for you to invest in a particular stock to gain multi-bagger returns. Second stock to avoid is the stock that has been touted as the next something. So, for example, that company that is said to be the next Apple or the next McDonald's. And these are the stocks that you should be beware of, because when it happens, it most of the time it marks the end of the prosperity of both of the companies, the imitator and the company which is it is compared to. Third is the company which diversify itself, which actually spends money in worsening its business operations. Now, instead of buying back shares or increasing dividends, what they do is they invest money or kind of waste money in the foolish acquisitions. Now, mainly they acquire businesses, first, which is overpriced, and second, which they barely understand. And when the diversification happens, corporation mostly alternate between rampant diversification, which is the acquisition of other small businesses, and then rampant restructions, which is selling off the acquisitions at a lower price compared to the original price. Now, there are two good things for the investors here. First is owning the shares of the companies that is being acquired, and second, to find the turnaround opportunities among the victims that have been restructured. And one thing to understand is it's not always foolish to make acquisitions. So for this, consider example of Berkshire Hathaway. You might not have known about this organization if it had stuck to its textile business. You know about this, and it has become such a big conglomerate because of its acquisition only. So the only trick here is to know how to make the right acquisition and then manage them successfully. And there's a term called synergy among businesses, which means is putting related businesses together and then making the whole thing work. And you can see it an example of, let's say, a hotel chain. Let's say Marriott, and it acquires some kind of restaurant chains. Now these hotel chains and the restaurant business, both of these are kind of related, and if both of them come together and then work together, is going to have a synergy between these businesses, and these kind of acquisitions can make you a lot of money. Now, third point is to beware of the whisper stock. Now, these are the stocks that are being told you by some friends or colleagues, and these are on the brink of solving some of the latest national problems, which can be curing cancer, drug addiction, oil shortage, etc. Now, this solution is either very imaginative or kind of complicated. And these are the stocks that have kind of hypnotic effect on you and have a emotional appeal. Now, these are the stocks that have a great story, but they don't have any substance to it. That is, they don't have a good business model and they don't have a good balance sheet. Now, these are the stocks that you would hear at the time of IPO. And it's often said that by the IPO, else it is too late. And this statement in itself is rarely true because there are some of cases where early buying can give you fantastic profits in a single day. But IPOs of brand new enterprises are very risky because they don't have a track record and you have a very little info based on which you can have an educated guess that if the price that you're paying for that stock is undervalued or not. So you will be better off investing in the IPOs of the companies that have been spun out of the other big companies. Because in this kind of situations, you'll find a lot of track record of the new entity and you can have a better guess. And the fourth is to beware of the middlemen. And when I'm talking about the middlemen, so these are the companies that act as a producers of something for other companies, and they have majority of their business to a single company. So for example, we can see of the Apple computers, where the Intel as a company was the major producer of the Intel chips for these Macs. Now, now, in this case, Intel might not have that much share of the Apple computers, but in general, if we see in our hypothetical situations that the 30 to 40% of the Intel chips business came from the Apple or the Mac computers only. Now, in this case, you never know when Apple starts manufacturing their own chips, which has happened recently. And in this case, like 30-40% of the business of Intel has vanished in just a blink. Also, the other thing that can happen is when Apple is the only source of business to Intel, they can extract price cuts and other concession that will reduce the Intel's profit. And the fifth point is to beware of the stocks with a flashy name, because the companies with an exciting name often attracts a lot of investors. And if that company is kind of mediocre or or a poor and don't have a strong balance sheet, this is just a recipe of disaster, because a lot of people are going to invest just because of their kind of flashy name and they don't want to have that kind of FOMO of not investing in this company, and it is going to boost up the stock price, and as there's no substance to it, it is going to go down just as quick it went up. So this was a whole discussion about the stocks that you need to avoid. In the next video, we'll be talking about the earnings and other factors that you need to look at while investing in the company. So that's it for today's video. See you in the next one.